Welcome to today's episode of Jonathan on Money. This is episode number 118. This week we're going in focus where we explore more advanced wealth planning topics. And today we have a slightly different format. Given the recent passing of the One Big Beautiful Bill Act the other week, we're joined by attorney Martin M. Shenkman, founder of Shenkman Law, to give an overview and breakdown of some of the key planning ideas under this new bill. I guess the best place to start first is with a bit of an overview. What is the Big Beautiful Bill?
Um, it's I'm not going to get into the non-tax stuff. It's just a massive piece of legislation that made it through by the skin of its teeth through Congress and was signed by President Trump that has, apropos to our discussion, massive changes to many tax provisions. The bill also has a wide range of other provisions that I can't comment on, and they're not my area of expertise. But from a tax perspective, it's a very substantial piece of legislation. It certainly is as substantial, probably more so than the 2017 Tax Act that made wholesale changes to many of the tax clauses. What this does that's so important for investors is it changes for many people dramatically how they should do estate planning, tax planning, charitable planning, and so on. It's very significant. And some of the changes, while they may sound simple, are far from that.
Has planning become more difficult due to the Big Beautiful Bill?
It's become more difficult and more complicated. Let me try to explain a little bit of why. I think for not only individual taxpayers, but for their advisors, it's going to be much more difficult, much more complicated because different people, different taxpayers will face a very different tax planning situation. And the results, the differences in planning versus not could be huge. So, for example, if you're able and have the wealth to invest in qualified opportunity zones, so if you realize a large sale gain, capital gain on the sale of your business, you may be able to eliminate all that tax cost. If you have a business that has significant capital requirements, real estate, you can invest and take very large write-offs in the early years under the OBBA, we'll call it OBBA provisions. So there's very specific differences by the type of assets you have, who you are, the activities you're engaged in. So for QSBS, if you're investing in a startup company, you may want to do it as a C Corp, not in an LLC or an S Corp, and you may be able to have incredible tax savings if you later take the company public. On the flip side, some people will qualify for tip or overtime exclusions. There's just everything's been changed. But here's what makes this bill so difficult, and it's different than any bill I've seen in 40 plus years of practice. It's so different by taxpayer. So you may have some wealthy people that can invest in some of the new tax benefits or in ways that will generate these new tax benefits that may pay very little or no tax. You may have other wealthy people who, because they're in different activities or just earning investment income, may not be able to. You may have physicians, as an example, that are making high income but can't qualify for the 199A deduction at 20%. They may be having income well above the new SALT limitation. And we'll go through some of this time permitting in a few minutes. So they may be paying a very high marginal tax. Somebody in a lower bracket may qualify for the new SALT deduction. They may qualify for the 199A deduction and have a very different tax picture. So it's going to be very specific and individual by person what to do and what the consequences are. So one of the big cautions, do not put your situation into some AI program or read an article and think it's going to work for you. Everybody's pretty much different.
Has estate planning become more simplified due to this bill?
Of course not. What would I do? Um, Let me tell you the simple interpretation, which is compelling, but very wrong and frankly, very dangerous. First, the simple concept. Golly gee, we now have a $15 million permanent exemption. So if your net worth as an individual is 10, 12 million, or as a couple is 25 million, maybe 27 million, do you even have to think about estate tax? I'll just get a simple will. First of all, you can't estate planning, wills, trusts, it's not just about what the estate tax is. Everybody has to deal with family issues, with potential for lawsuits and claims, et cetera, et cetera, et cetera. Estate planning has never just been about tax. So to think that everything can just be a simple couple page document because taxes don't apply to you, that you're missing the point. That's a really terrible mistake. Second, the pendulum swings far to the right, far to the left. I don't mean that in a political way, just one way, then the other way on tax policy. If we have a new administration, whether it's in 28, 32, whatever, if it ends up with a new administration in the future, we may very well see very significant tax increases. Everybody is aware of how massive and growing the budget deficits are. One of the ways they may address the budget deficits is raising taxes. So I think it's imprudent and short-term, short-sighted to say, golly, we have a permanent exemption. That was air quotes in case you didn't realize. Who knows what permanent is in Washington? If you have an opportunity now to plan and move assets out of your estate, because the laws may change very unfavorably in the future and it may shift far to the other direction, why not do it? And another very important point, and I mentioned this already, but it's really vital, asset protection. We live in one of the most litigious societies, if not the most litigious society in the history of the planet. That's not going to change. It has nothing to do with politics. That's just our culture. So if you shift assets into appropriate trust where you can have access, but protect them from your creditors, that those trusts properly planned can also safeguard you from future estate taxes. So I think saying estate planning is now simple may miss the boat. Final point, and we'll come to it in one of the next questions, I think. Estate planning is also about income tax planning. So many people, including advisors, assume that estate planning is about estate tax. No, it's about all the myriads of things that go into estate planning, including income tax planning. And hopefully, we'll have a few minutes to talk about non-grantor trusts and income tax planning. Proper estate planning, well done estate planning, can help you save a lot of money on your income tax bill.
I guess now we're going to get into the big meat of the question. How can estate and trust planning help you get income tax benefits after the big beautiful bill?
What a great question.
Glad I asked.
So let's take an example, but I'm going to be careful with numbers so I don't make it more complicated. So one of the things when I said earlier that this new big beautiful bill, OBBBA, is very complicated, that so many of the tax provisions have different phase outs in terms of years. So the benefit for tips disappears in 3 years if it's not reenacted. The estate tax exemption increased to 15 million permanent inflation adjusted. That's permanent. That's forever. There's tremendous variation how long stuff lasts. There's also variation by income levels. So for example, a lot of people are familiar with the SALT, SALT, state and local tax deduction. If you live in a high tax state, New York, New Jersey, California, Massachusetts, Illinois, you pay potentially a very significant amount of state income tax. And in 2017, they capped or limited the amount you could deduct as an itemized deduction to $10,000, which for many people was barely a drop in the bucket. So you're really getting hammered paying a high state income tax and property tax and getting no deduction. So you're in effect paying income tax to the federal government without a deduction for the state taxes. So the OBBBA, or Big Beautiful Bill, has increased that cap from 10,000 to 40,000. So everybody in New York, New Jersey, et cetera, has all done a happy dance. Oh boy, I can deduct more of my taxes. Now, for a lot of people, 40 grand is still well below what they're paying in local taxes, but at least it feels like relief. Well, don't count your chickens. What is it? The chickens before they hatch. That is phased out when your income hits $500,000. You start to lose the extra 30,000 that was just added. When your income reaches $600,000, you have none of the additional or new increase in the SALT limitation. So you get no extra deduction. You're back at 10 grand like you were before. I think a lot of people only hear the headlines. They don't realize the phase outs. So why is that relevant? Let me give you another example. If you want to take a charitable contribution deduction, that's reduced by 0.5% of your income. There's a reduction, a haircut on charitable contributions. Total itemized deductions are reduced by, and catch this fraction, 2 over 37ths of the excess of your income over the amount of income you need to get to the maximum 37% bracket. It basically knocks your deduction from 37% to 35%. So you got haircuts on your charitable contribution deductions. You also have a whole bunch of other limitations based on income and so on and so forth. So you may not get a deduction for charity. What does this have to do with estate planning? What does this mean you can do? You can set up, and now I'm going to try to keep it simple, but go back to the complexity I just talked about. You can set up what's called a non-grantor trust. A non-grantor trust is a trust, generally speaking, that pays its own income tax. Just by contrast, a trust is a grantor trust when you, the person who set it up, you, Jonathan, set up a trust for your family, you pay the income tax on it. That's a grantor trust. If you set up a trust that the trust pays its own tax, that's a non-grantor trust. Why is that kind of trust planning important? And this, for an awful lot of people, is going to be the use of trust planning, not slats or other ways to save estate tax, not just a revocable trust to avoid probate. Listen to this because it's different than what most people know about. You could set up a non-grantor trust. Let's say you put 250 grand in the non-grantor trust. The 250 grand generates 12.5 of income. You can make the trust can pay charitable contributions you want made and get a dollar for dollar offset without all these limitations. So let's say because of the SALT limit and all these other limitations on standard deductions, you can't itemize. And you also, a lot of people aren't going to itemize because now the standard deduction is up to 31, I think it's 31,500 for a married couple filing joint. So in effect, you're taking some of your investments, non-pension, non-retirement, putting them in a non-grantor trust. That income is then used to pay charity. You get the full standard deduction and you use the full contribution to offset the income from the trust. In effect, what you've done is eliminated all the income tax that you would have had on that portfolio that hopefully they're investing with you and moved it to where it becomes tax-free. That's a huge planning opportunity. Let me, at the risk of belaboring this, but I think it's so important to understand because this is going to be the focus of a lot of planning for people. If you have 600 grand of income, you only get a 10 grand SALT deduction. For a lot of people in New York, they're not going to be happy about that. And I don't think a lot of people have realized that because that's not something the news media has really focused on. Let's say you're earning a salary of 500 grand at work and you're making 100 grand of income on your portfolio. With a $15 million exemption, you can move as much of that portfolio that's generating non-pension portfolio that's generating that 100,000 of income into a non-grantor trust. Now the trust realizes the income, you don't. Your income is now $500,000. You now get your full SALT deduction simply by shifting investment assets from your name, Jonathan, to the Jonathan Family Trust. You can reduce your income and get your tax benefits. Similar planning can qualify for the 199A deduction, which is a 20% haircut on the income you're earning from certain flow-through entities, et cetera. So there's many different applications of this planning, but the idea is to shift the income from you to a non-grantor trust. You can offset the income in the trust by paying charity, which it gets a dollar for dollar deduction. You have to meet what's called the 642C requirements, paying from gross income. There's some requirements you have to meet, but you can get dollar for dollar deduction for charity. You can maximize your personal deductions all at the same time. What I just described is going to be a really important focus for many, not all, taxpayers after the big, beautiful bill. It's a significant change in how to view estate planning. We have now taken estate planning and trusts and repurposed it to save income taxes and take advantage of the tax benefits of the big, beautiful bill. Most of what consumers see about trusts are revocable trust to avoid probate. That doesn't do anything to help your income tax picture. So I wanted to belabor because I want to make sure people understand the concept. This is something to talk to their estate planners and their accountants and their investment advisors about.
So we covered a lot here today, and as we wind down, can you give listeners a list of other changes they should be aware of with this big, beautiful bill?
Sure. So here's the thing. I'm going to rattle off a few things and mention them to you. I've rattled off a bunch already. I tried to focus your attention on a couple of things that I thought could be very powerful for different people. But keep in mind that the big beautiful bill affects so many different tax benefits, that any quick summary you read or see anywhere is only going to touch some of them. If you have somewhat unusual circumstances, make sure you find out if there's anything specific to you that any summary like this can't do. So miscellaneous itemized deductions have been basically eliminated. Unreimbursed employee business expenses, unless you're a teacher, those are gone. Itemized deductions that I mentioned earlier, you get a haircut of 2/37. Is that a crazy enough fraction of that? There's an exemption. They advertised it, and this is so typical. Why you have to be careful. They advertised that you don't pay tax on Social Security, but what they really did is they gave a $6,000 temporary exemption for people age 65 and over. But that benefit is phased out as soon as your income hits 75,000 for an individual or 150,000 for a married couple. So wealthier people are going to pay full tax on their Social Security. People with lower income may not. Qualified business income, QBI. QBI, that's the 199A deduction I mentioned. You get to exclude 20% of the income from pass-through entities. So if you have a rental property, if you have a side business, you may be able to avoid 20% of that income being subject to tax. That's really significant. Those things are phased out, but they increased it so that more people will qualify. So if you didn't qualify before, you need to look at that again. That may affect how you structure your activities. So let's say you're a doctor, but you sell products in your office, or you own the building and pay rent. Those things should be in a separate entity, not in your medical practice entity, because you may be able to get a 20% discount on what has to be taxed from those profits. So big incentive to evaluate how you structure your activities. Trump accounts are a new savings tool that generally limits what you put into 5,000 a year. That's inflation adjusted. The government will give you a one-time $1,000 payment. I think it's one time. I may be wrong. And you can't take money out until the child turns age 18. I'm not sure why somebody would do that unless they've maxed out on 529 plans, because the money that comes out of a Trump account has to be taxed at capital gains, whereas the money that comes out of a 529, if used for appropriate purposes, is not taxed at all. 529 plans were made more flexible and can be used for grade school and secondary education. So that gives you much more flexibility in that. There's a whole raft of business and depreciation and bonus depreciation rules. If you have business and investment endeavors, I didn't want to get into that because we're trying to limit this more to investors in securities and not business owners, but that has an array of benefits that could really be huge. One of the things to keep in mind for people that can qualify for even some of the huge new business benefits, they may find their marginal tax rate is very low or zero. So think how that changes charitable giving. Some people won't get any tax benefit from giving to charity if they pay no tax because of the other big benefits. And this is going to be very different from person to person. So you need to really evaluate what you're doing for you and not assume that something you read online or what AI summary tells you is going to necessarily apply to you. So make sure that the advice you get fits your circumstances and look at the details.
You did mention something about business owners. Is there any other points you'd like to mention that may be of particular interest to business owners?
Well, the 199A deduction is huge. The QOZ, Qualified Opportunity Zone, is huge, and they've restructured that. I think it kicks in 2027. so that if you have a large gain from selling a business or planning to sell a business in 2026, you may be able to creatively use an installment sale or a charitable remainder trust to sort of defer and flip to the 2027 when you can put it into a QOZ. And if you hold the QOZ long enough, you may pay no tax. So it's an interesting opportunity for someone looking to retire and sell their family business or real estate properties, perhaps, to defer all tax. They also have qualified opportunity zone funds. I'm not sure if that's QOF or QOZF, lots of new acronyms, but you can get a prepackaged fund that invests in qualified opportunity zones and not have to make the actual investment yourself. There's special production facility provisions that if you create a building and you put in it all kinds of equipment for production, if you meet the requirements, you can write it all off in year one. So people making big investments, and obviously the intent was to stimulate local investment in the U.S., can get massive deductions. So there's a lot out there for businesses, and this may affect stuff as basic as, do I form what type of entity? The default answer in most cases is every new entity was formed as an LLC. That may not be what you want. So there's really huge opportunities to continue to do estate planning, to save income taxes, to protect your assets, because we may have a flip in Washington at some point. Why not get the planning done while the planning can be done? So the simple answers, they're there. I don't know that they're really optimal for many people.
Great. Thank you so much, Marty, for that informative overview. And one last item before I let you go today, which is my upcoming fall live webinar series begins Thursday, September 4th at 8:30 a.m. New York time. And if you're not currently in my webinar distribution list or would like to be notified of my upcoming live webinars, feel free to email me with the word webinar in the subject line or go to parkbridgewealth.com/webinars to be added to my webinar distribution list. And with that, it's a wrap for this week's show. Any comments or questions, feel free to reach out directly to me via email. I love hearing from my listeners. And finally, as I end every episode, the secret to financial success is no secret at all. It's to spend less than you make, invest the difference prudently, and ignore all the noise. See you next time on Jonathan on Money.